Earnings reports are among the most important financial disclosures for investors and traders. They provide a clear snapshot of a company's financial health, performance, and future outlook. By understanding how to analyze these reports, investors can make informed decisions, seize trading opportunities, and manage risks effectively. Whether you're a long-term investor or a short-term trader, knowing how earnings impact stock prices can give you a strategic edge in the market. Earnings reports are critical financial disclosures that publicly traded companies release every quarter. These reports provide key insights into a company's revenue, expenses, and net income, helping investors, analysts, and stakeholders evaluate financial health. They play a vital role in stock valuation and investment decision-making by offering transparency into a company's performance. Additionally, companies are required to report earnings in compliance with regulatory bodies such as the SEC in the US. Earnings reports consist of three key financial statements that provide a complete picture of a company's performance. The income statement highlights revenue, net income, and earnings per share, helping assess profitability. The balance sheet details assets, liabilities, and shareholder equity, offering insight into financial stability. Lastly, the cash flow statement tracks the movement of cash within the business, which is crucial for understanding liquidity and cash reserves. Together, these components help investors and analysts evaluate a company's overall financial health. Earnings reports also include key metrics like earnings per share, EPS, and forward guidance, which provide deeper insights into a company's performance and future outlook. A higher EPS indicates stronger profitability per share, making it a critical measure for investors. Forward guidance reflects management's expectations, including growth forecasts, potential risks, and strategic plans. Earnings reports have a significant impact on stock prices, often triggering strong market reactions. When earnings exceed expectations, stock prices tend to rise, as seen with Apple, whose stock jumped 5% after strong iPhone sales. On the other hand, missing analyst expectations can lead to a sell-off, like when Meta's stock dropped 20% after reporting lower ad revenue. Additionally, the market sometimes overreacts in the short term, with exaggerated price movements. Earnings reports can create significant price movements, impacting traders' decisions. For example, Tesla reported record deliveries, but lower margins led to stock volatility, first jumping 6%, then dropping 7% after cautious guidance. Amazon's sales exceeded expectations, but higher operational costs caused a 4% decline, as traders reacted to profitability concerns. Meanwhile, Netflix experienced a major 35% drop after reporting its first subscriber loss in a decade. The key takeaway for traders is that earnings alone don't drive price action. Market reactions to earnings reports are influenced by several key factors that traders must consider. Earnings guidance plays a major role. Strong future outlooks can push stocks higher, while weak guidance can drag them down, even with good earnings. Economic conditions, such as inflation and interest rate hikes, also impact price action, as seen with growth stocks falling after Federal Reserve rate increases. Industry trends matter too. Stocks often move based on how a company performs relative to competitors. Lastly, investor sentiment, especially from institutional traders, can drive large price swings, sometimes causing short-term volatility. Post-earnings announcement drift, or PEAD, refers to a stock's tendency to continue moving in the direction of an earnings surprise for weeks after the report. This happens because institutional traders often adjust their positions gradually, while retail traders react more slowly to new information. Understanding PEAD can help traders develop strategies to capitalize on momentum. For example, if a company beats expectations, taking a long position could be beneficial, as the stock may continue drifting higher in the following weeks. Recognizing this pattern can give traders an edge in timing their entries and exits. Earnings calls are crucial events where company executives discuss financial results and answer analyst questions. These calls provide traders with deeper insights into a company's future strategy, potential risks, and growth opportunities. Analysts often ask tough questions, uncovering details that may not be reflected in the earnings report alone. A strong or weak statement from management can significantly impact stock prices, as seen in 2021 when Elon Musk's comments during a Tesla earnings call triggered major price swings. For traders, monitoring these calls can be key to anticipating market reactions and adjusting positions accordingly. The Enron scandal is one of the most infamous cases of corporate fraud, showing how deceptive accounting can lead to catastrophic market consequences. Enron manipulated earnings by using mark-to-market accounting, recognizing projected profits as actual earnings while hiding losses through off-balance sheet entities. Once the fraud was exposed, the stock price collapsed from over $90 to less than $1, wiping out billions in market value. This scandal had a major impact on financial regulations, leading to the Sarbanes-Oxley Act in 2002, which enforced stricter reporting standards. For traders, it serves as a reminder of the risks associated with misleading financial statements and the importance of due diligence. Earnings reports are key events that create significant trading opportunities due to increased volatility. They influence stock price trends and trader sentiment, often leading to price inefficiencies when market expectations don't align with actual results. Traders use various strategies to capitalize on these movements, such as pre-earnings trading to anticipate direction and post-earnings gap trading to profit from volatility. Momentum trading focuses on stocks that react strongly to earnings surprises, while options strategies like straddles and strangles help manage risk and maximize returns. A pre-earnings trading strategy involves taking positions ahead of an earnings report to capitalize on expected price movement. Traders analyze historical earnings trends, stock reactions, and analyst sentiment to anticipate volatility. For example, Tesla often moves 5 to 10% after earnings, leading traders to buy out-of-the-money options before the report. However, this strategy carries risks. Unexpected earnings surprises can cause sharp reversals, and high implied volatility makes options expensive. Careful analysis and risk management are crucial when trading ahead of earnings events. Post-earnings gap trading focuses on taking advantage of large price gaps that occur after earnings reports. When a stock gaps up or down but its fundamentals remain strong or weak, traders look for potential reversals. For example, Meta dropped 20% in a single day after weak earnings, and traders waited for stabilization before entering long positions near key support levels. Volume confirmation, RSI, MACD, and moving averages are essential indicators to identify strong trade setups. Momentum trading on earnings surprises takes advantage of strong price moves that continue after an earnings release. When a company significantly beats expectations, traders look for continued upside, as seen with Netflix jumping 15% post-earnings. On the other hand, a major earnings miss can lead to extended declines. This strategy leverages post-earnings announcement drift, PEAD, where price movement persists for days or weeks. Traders enter positions after earnings based on price confirmation and use trailing stop losses to lock in gains while riding the trend. Options trading around earnings offers unique opportunities for traders looking to capitalize on volatility. One key factor is implied volatility crush, where it spikes before earnings, making options expensive, and then drops afterward, reducing their value, something traders can exploit by selling options early. The straddle strategy involves buying both a call and a put to profit from big price swings in either direction, while the strangle strategy uses cheaper out-of-the-money options for a high-risk, high-reward setup. For example, if Amazon is expected to move plus or minus 8% post-earnings, a well-placed straddle can yield profits if the actual move exceeds the option cost. Analyzing earnings reports is essential for traders looking to gauge a company's financial health and potential stock movements. Key metrics to watch include revenue growth, earnings per share, operating margins, and forward guidance, as they indicate profitability and future expectations. Free cash flow is also crucial, as it reflects a company's ability to reinvest and sustain growth. However, traders should be cautious of red flags, such as rising net income despite declining revenue, large GAAP versus non-GAAP discrepancies, or excessive stock buybacks inflating EPS. Apple's earnings reports have historically triggered significant price movements, making them a key focus for traders. Large swings often occur due to unexpected beats or misses in revenue, iPhone sales, or guidance. Traders use strategies like options straddles to capitalize on volatility, pre-earnings run-ups to benefit from anticipation, and post-earnings reaction trades to capture reversals or continuation trends. In Q1 2019, Apple's downward revision of revenue guidance led to a major sell-off, highlighting the market's sensitivity to forward-looking statements. However, strong growth in services and wearables later stabilized the stock, showing how different segments can influence long-term price action. Risk management is crucial when trading earnings, as volatility can lead to large price swings. Traders can hedge by using options, diversifying trades, and setting stop-loss orders to minimize potential losses. Position sizing is also key. Allocating no more than 5 to 10% of a portfolio to an earnings trade helps manage risk effectively. Common mistakes include ignoring guidance, over-leveraging, and chasing price moves after a stock has already reacted. By applying proper risk-reward strategies, traders can protect capital while still taking advantage of earnings-driven opportunities. Earnings trading offers both opportunities and risks, making it essential for traders to have a structured approach. A solid strategy that includes thorough analysis, risk management, and the right trading techniques can help navigate the volatility of earnings season. Whether using option strategies, momentum trading, or post-earnings reactions, understanding key factors like guidance and market sentiment is crucial. While earnings can create significant price movements, disciplined risk management ensures traders can capitalize on these moves without exposing themselves to unnecessary losses. By staying informed and prepared, traders can make smarter, more confident decisions during earnings season.